Most people think an audit begins when an IRS agent opens a file. That is old thinking in the world that is taking shape. Now, an audit begins long before a human being ever looks at your name. It begins the moment your return starts sending signals. A deduction too large for your income, a side hustle that leaves a trail on payment platforms but not on your tax return. Crypto profits that touched an exchange, got recorded, and somehow disappeared when it was time to file. A business vehicle that is magically 100% business until it shows up in family life. A home office that somehow occupies half an apartment and yet doubles as the place where dinner is served. Most people do not lose to the tax system because they are criminal masterminds. They lose because they are sloppy, emotional, and arrogant in small ways. They think the government is blind because the government is big. That was always dangerous. It is becoming fatal. I have spent my life thinking about systems. I like systems because they punish fantasy and reward arithmetic. Markets do that. Businesses do that. Compounding does that. Taxes do that too. The tax code is not a morality play. It is not a place where good intentions rescue bad records. It is a ledger. And the people who treat a ledger like a diary usually end up paying tuition to reality. The first thing I want you to understand is that the modern tax system is moving away from the old image. Most people still carry in their head. They imagine a tired office, a stack of paper, a board examiner, and a bit of luck. They think if staffing gets cut, enforcement gets softer. That sounds reasonable until you realize the real bottleneck was never the lack of paper. It was the lack of pattern recognition. Once pattern recognition scales, the game changes. The way I would describe it is simple. Your tax return is no longer being dropped into a pile. It is being placed inside a radar field. And radar does not care about your excuses. Radar cares about contrast. If your return looks normal relative to your income, your business type, your location, your filing behavior, and the statistical habits of people who look like you on paper, you stay dim. If your return glows brighter than the pattern around it, you move from background noise to active target. That is the mother line for everything I am going to tell you. The tax game in front of you is no longer just about what you can deduct. It is about how brightly you show up on the radar. Most people focus on saving tax dollars and never ask the more strategic question. What is the signal I am sending? That question matters because the system does not begin with punishment. It begins with sorting. The return gets scored, ranked, compared, and separated. The returns with the strangest signal move closer to human review. A smaller group moves from review to scrutiny. A smaller group still moves from scrutiny to audit. That means the goal is not merely to be right in some abstract sense. The goal is to be right and legible. I want to say that again because it is where intelligent people make stupid mistakes. You do not merely need truth. You need proof arranged in a way the system can understand. That is a very different game from the one most people think they are playing. The first mechanism inside this radar field is what I call deduction distortion. That is when the deduction is not necessarily fictional, but it is out of proportion to the economic picture around it. The easiest example is the home office. A home office deduction sounds innocent because sometimes it is innocent. Sometimes the office is real, exclusive, measurable, and used for actual work. But plenty of people hear that phrase and translate it into something else. They begin with a kitchen table and end with a fantasy. They start with a corner of the living room and mentally expand it until it becomes a business headquarters. That is not accounting. That is desire wearing a calculator costume. The danger is not just that the deduction might be weak on its own. The danger is that it may be too large relative to the income it is supposed to support. A modest side business that somehow produces aggressive lifestyle write-offs is exactly the sort of contrast that brightens your signal. The system does not need to know your intentions to notice the mismatch. It only needs to see a pattern that looks wrong. People underestimate this because they think in absolute numbers. The system thinks in ratios. That is one of the most important ideas in this entire subject. A deduction is not judged only by what it is. It is judged by what it is relative to. Relative to your income, relative to your profession, relative to similar filers, relative to the footprint of the business you claim to run. A weak deduction with excellent documentation can survive. A technically plausible deduction with absurd proportions becomes suspicious. That is why disciplined people win here. They do not just ask, "Can I take this?" They ask, "If someone compared this to 1,000 returns like mine, would this look ordinary or theatrical?" The second mechanism is what I call lifestyle leakage. This is where personal life bleeds into business claims and destroys credibility. The classic form is the heavy vehicle deduction. People hear that a large vehicle may qualify for accelerated write-offs and immediately start shopping like the tax code is handing out free luxury. They think the vehicle weight is the strategy. It is not. The usage is the strategy. The records are the strategy. The separation between business and personal use is the strategy. If the car is truly a business asset used predominantly for business, that can be defended. If it is a personal toy dressed up as a business necessity, the radar sees leakage everywhere. This is the mistake amateurs make in every field. They hear the rule and ignore the conditions attached to the rule. They want the upside without the discipline. In markets, that gets you margin calls. In taxes, that gets you questioned. And once the questioning starts, the problem is not limited to the car. Credibility starts to bleed across the entire return. One stretched claim invites curiosity about the others. You must understand that credibility compounds in both directions. A clean return with modest documented claims creates an aura of order. A return with one loud gimmick invites a broader look. And broader looks cost money, time, stress, and sometimes sleep. That is why I have always liked conservatism in reporting, not cowardice. Conservatism. There is a difference. Cowardice leaves money on the table because it is afraid to use the rules. Conservatism uses the rules, but refuses to push the story beyond the evidence. That is a profitable way to live. The third mechanism is cash fog. Cash fog is one of the oldest temptations in commerce because cash whispers the same lie to every generation. It says, if no one sees it, maybe it never happened. The problem is that businesses do not exist in a vacuum. A nail salon, a small restaurant, a service shop, a barber shop, a contractor, a handyman business, a corner retail operation. These do not merely create income. They create a profile. There is a geography to them. There is a normal range for them. There is a rhythm to how businesses of that type behave in a zip code, in a region, in a category, in an economy. When reported revenue falls too far below the pattern, fog becomes signal. People imagine they are hiding from a person. In reality, they are deviating from a data set. That is a much harder thing to hide from. The arithmetic here is cruel because the short-term gain feels small and the long-term risk is large. Someone pockets $10,000 and feels clever. What they fail to price in is the cost of being wrong. Penalties, interest, professional fees, back and forth letters, the emotional tax of wondering whether the next envelope ruins the month. And in serious cases, something worse than money leaves the room. Peace leaves the room. I have no interest in paying $1 more in tax than the law requires. I also have no interest in living like a hunted man over a sum that disciplined accounting could have handled honestly. That is the adult standard. The fourth mechanism is the platform trail. This is where the side hustle generation gets ambushed. Not because earning extra income is wrong, but because modern payment systems leave marks everywhere. People sell on marketplaces. They collect through payment apps. They move money across platforms and then make the fatal mistake of mixing business activity and personal activity in the same stream. Rent reimbursement lives beside side gig revenue. A birthday payment sits next to handyman work. Reimbursement for dinner lands in the same account as online sales. Then tax season arrives, and the person is no longer doing accounting. They are doing archaeology. That is expensive. When streams mix, clarity dies. And when clarity dies, either you spend more money reconstructing reality, or you guess. Guessing is poison in tax reporting. A business account is not a luxury for large enterprises. It is a defense system for anyone who wants their records to remain intelligible. Separate inflows, separate outflows, a tax reserve, clean categorization, a trail that explains itself without drama. That is how serious operators behave, whether they make $5,000 or $5 million. I have watched people obsess over investment returns while ignoring administrative order. They will spend 100 hours chasing another percentage point in a portfolio and refuse to spend one afternoon separating their business transactions from their personal life. That is upside-down thinking. A good system is often more profitable than a heroic idea badly recorded. The fifth mechanism is what I call invisible visibility. Crypto investors know this one in their bones, even if many still try to outrun it. They think because the asset is digital, the trail is abstract. It is not abstract where compliance is concerned. Once transactions touch reporting entities, once gains surface through exchanges, once records get transmitted, The problem is no longer whether the system can see you. The problem is whether you are pretending it cannot. This is where people become victims of their own mythology. They love the idea of independence. They love the language of decentralization. They love the feeling that they have stepped outside the old financial order. Then tax season arrives and they discover something unpleasant. Freedom of transaction does not mean freedom from arithmetic. The tax system may not calculate the number for you in a way that feels generous, but it is often aware that a number exists. That is enough to create danger. There is a nasty asymmetry here. If you over-report income, the system usually does not rush in to save you from yourself. If you under-report income that can be matched against records elsewhere, the system suddenly becomes very interested in your existence. That is why documentation wins again. Not ideology, not internet folklore, not a thread from a stranger who made a viral video about how taxes do not apply to him because he has discovered some secret interpretation of sovereignty that no court in America has ever endorsed. Documentation wins. Basis, purchase date, sale date, transfers, gains, losses, a coherent trail. Those things win. The sixth mechanism is bracket gravity. As income rises, attention rises with it. This should not shock anyone. The system goes where the money is. If you earn more, invest more, own more, and structure more, you should expect a larger compliance shadow around your life. The mistake people make is waiting too long to professionalize. They start with simple returns and do them casually. Then a side business grows. Then another income stream appears. Then investments diversify. Then a property enters the picture. Then maybe a partnership. Some contract work. Maybe digital assets. Maybe multi-state complexity. Maybe larger deductions. The life gets more complicated. But the reporting habits remain adolescent. That gap is where expensive errors breed. A good accountant costs money. An audit, a misfiling, bad advice, penalties, or years of lazy bookkeeping cost far more. I learned a long time ago that people often buy cheap advice because the invoice is visible while the cost of poor advice is delayed. Human beings are suckers for visible savings and blind to deferred pain. That is why so many people brag about how little they spend on professional help, right before discovering they have been paying for the wrong kind of thrift. The intelligent move as your life expands is to upgrade the people around you before you upgrade the optics of your life. Do not buy the bigger car before you buy the cleaner accounting system. Do not posture as rich while filing like an amateur. That is reverse intelligence. Now, let me pull all of this together into the broader principle, because the broader principle is where real money is saved. Most people think taxes are about deductions. They are half right. Taxes are about behavior. Every deduction sits on top of behavior. Every filing position sits on top of a process. Every clean return sits on top of habits that are boring before they become valuable. Keep records, separate accounts, track usage. Save receipts where it matters. Preserve logs. Understand what a business expense actually is. Stop improvising after the fact. Stop asking whether you can get away with something and start asking whether you can defend it without embarrassment. That is how adults operate in systems that remember. The future of tax enforcement, as I see it, is not a future where every taxpayer is individually hunted down. It is a future where low-friction surveillance and high-volume comparison make sloppiness much more expensive. In the old world, inefficiency gave many people cover. In the new world, efficiency removes that cover. The audit does not need to become universal to change behavior. It only needs to become predictable enough that marginal gains lose their appeal. That is exactly how many powerful systems work. They do not need to punish everyone. They need enough visible consequences, powered by enough credible detection, to make discipline the cheaper option. Once you understand that, the right response becomes obvious. You do not panic. You do not become paranoid. You do not stop taking lawful deductions out of fear. You simply stop filing like a storyteller and start filing like an owner. I have always believed that ownership begins with accepting reality before it becomes fashionable. When the world changes, you do not win by clinging to a picture of how it used to work. You win by noticing the change early, adjusting your system, and letting slower people pay the price of denial. That is what is happening here. The system is becoming better at recognizing mismatches. That means your job is to reduce mismatch. Not by hiding less cleverly, by structuring more intelligently. The person who will do well in this environment is not the person with the most aggressive deductions. It is the person whose economic life is arranged coherently. The person who can explain every claim. The person whose personal and business money do not mingle like strangers at a wedding. The person whose reported reality resembles actual reality closely enough that scrutiny becomes survivable. The person who treats taxes as part of wealth building rather than an annual ambush. If you want wealth, you must eventually become fluent in friction. Taxes are friction. Compliance is friction. Record keeping is friction. The people who master friction keep more of what they earn because they stop paying unnecessary penalties to chaos. Let me make this practical, because theory without protocol is entertainment. If I were rebuilding my tax life from scratch in this environment, I would start with what I call the Audit Defense Operating System. The first piece is separation. If money is business money, it lives in business channels. It arrives there, it leaves there, it is accounted for there. The moment you mix business inflows with personal life, you invite confusion. Confusion is the seed from which misreporting grows. So the first rule is to stop creating confusion in the first place. The second piece is proportionality. Before I claim a deduction, I would ask whether it makes sense inside the scale of the activity producing it. Does the office size make sense for the income? Does the vehicle usage make sense for the business type? Does the expense support the economic reality, or am I trying to make the numbers flatter me? Whenever a claim feels like a clever trick, I assume I am already walking toward a problem. The third piece is documentation. Not piles of junk, not a shoebox religion. Useful records. Measured space for a home office. Photos when they matter. Mileage logs when vehicle usage matters. Receipts organized by category. Clear notes on mixed-use situations. Transaction trails, basis records, exchange records for digital assets. Documentation is not there to make you feel virtuous. It is there so that when memory fails, proof remains. The fourth piece is tax reserves. Anyone earning outside pure wage income should get used to the idea that part of every inflow does not belong to them. Set it aside early. Let it become a reflex. That simple habit protects people from the desperate behavior that starts when tax season arrives and the money is already spent. Desperation is when otherwise sensible people begin inventing deductions and rationalizing nonsense. The fifth piece is escalation. As complexity rises, support must rise. New income stream, new state, new property, new entity, new asset class. That is not the time to keep pretending your situation is still simple. Complexity that outgrows your expertise must be handed to someone whose profession is detail. That is not surrender. It is capital allocation. The sixth piece is consistency. A truthful story told inconsistently still looks suspicious. Use systems that make repetition easy. Categorize the same way. Report the same way. Treat similar items similarly. The machine sees jumps, spikes, and mismatches before it sees nuance. Consistency is one of the cheapest forms of protection you can buy. The seventh piece is restraint. This is the part almost nobody wants to hear because it lacks excitement. Not every lawful deduction must be taken in the most aggressive, imaginable form. If a claim is technically possible but poorly supported, heavily mixed, or likely to glow on comparison, restraint may produce a better after-tax life than aggression. Why? Because after-tax life includes stress, time, correspondence, reputational irritation, and the cost of defense. People who only model taxes in a spreadsheet do not understand this. Real life has carrying costs. That operating system will not make you perfect. It will make you harder to attack. That is enough. There is another layer to this that matters deeply to me, and it is about character. Money reveals people. Taxes do the same thing. A person who lies casually in small categories will usually lie casually somewhere else. A person who respects records, boundaries, and evidence in tax life often brings the same discipline into investing, marriage, contracts, and operating businesses. That is why I do not separate financial habits from moral habits as sharply as some people do. Sloppiness has a way of traveling. The man who cannot keep a clean mileage log is often the same man who cannot keep a disciplined portfolio. The woman who mixes every account because organization feels tedious often pays for that pattern in places far beyond taxes. Systems reveal self-government. And self-government is where durable wealth begins. So no, I do not think the right lesson here is to become frightened of the IRS. Fear is not a strategy. I think the right lesson is to stop relying on institutional weakness as a component of your personal financial plan. If your strategy requires the system to remain lazy, understaffed, or technologically behind, then you do not have a strategy, you have a temporary loophole built on somebody else's inefficiency. That is a rotten foundation for a life. Good lives are built on foundations that survive modernization. Good businesses are built that way. Good portfolios are built that way. Good tax habits should be built that way too. For years, many people got away with telling themselves that small distortions do not matter. Maybe sometimes they did get away with it, but getting away with something is not the same as building safely. A man can drive too fast for years and call himself skilled. Then one day the road changes. What matters is not the history of survival. What matters is whether the system can endure the next environment. This next environment will be less forgiving of inconsistency, weak substantiation, mixed accounts, and magical thinking. That is not a prophecy of doom. It is simply the natural direction of a world where data gets compared faster and more broadly than before. And that brings me to the final choice, because every serious financial decision eventually becomes a character decision. You can keep living like tax season is a performance, something you improvise with optimism and clean up under pressure, or you can start living like every economic action leaves a trail. Every trail and every story should be able to survive inspection. One path feels easier until the letter arrives. The other path feels stricter until you realize strict systems create loose lives. That is the test. Do you want the freedom of pretending or the freedom that comes from being ready? Do you want to spend the next decade hoping the machine does not notice you, or building a financial life that can stand there calmly when it does? I know which contract I would sign with my future self. I would sign the contract that says my wealth will be built on records, not rationalizations. I would sign the contract that says deductions must be deserved, documentation must exist, accounts must be separated, and complexity must be respected before it becomes expensive. I would sign the contract that says I will not let laziness impersonate strategy, because the world that is coming belongs to people whose numbers can survive light. And if your numbers cannot survive light, they were never really yours to count on.